Most business owners have experienced the same frustrating situation. You work hard, make sales, send invoices, close deals, and see money coming into the business. Yet, when you check your bank account, there never seems to be enough cash sitting there. You tell yourself that next month will be different. Next month, you will finally build a cushion. Next month, you will finally have $10,000 sitting safely in the bank. Then next month arrives, and the money disappears again. A supplier needs to be paid. Payroll is due. Software subscriptions renew, equipment breaks, taxes show up. Suddenly the account balance drops, and you are back where you started. This cycle is incredibly common. In fact, many businesses that appear successful from the outside struggle to maintain even a modest cash reserve. The problem is not always low sales. The problem is usually how money moves through the business. Today, we are going to break down the real reasons businesses struggle to keep $10,000 in the bank and the practical steps you can take to change that. The first reason is confusing revenue with cash. Many business owners see strong sales and assume they are financially healthy. Imagine a business that sells $50,000 worth of products in a month. On paper, that sounds great. But if $40,000 goes toward inventory, payroll, rent, software, insurance, advertising, and other expenses, the remaining amount is much smaller than it first appeared. It becomes even more complicated if customers pay slowly. A business may show $50,000 in sales, but if much of that money has not actually arrived in the bank account yet, the business can still face a cash shortage. Revenue is not cash. Profit is not cash. Cash is the money that is available right now to pay bills and survive unexpected problems. Many business owners spend years chasing higher revenue while ignoring cash flow. The result is a business that looks successful on reports but constantly struggles financially. Instead of asking how much revenue you made this month, start asking how much cash actually stayed in the business after everything was paid. The second reason is that many businesses grow too fast without building a cash foundation. Growth sounds exciting. More customers, more orders, and more opportunities seem like obvious signs of success. But growth often requires spending money before you receive money. Imagine receiving a large order from a new customer. You may need to buy inventory, hire temporary workers, increase advertising, or purchase equipment before getting paid. During that period, cash leaves the business faster than it comes in. This surprises many entrepreneurs because they expect growth to solve their financial problems. Instead, growth sometimes creates bigger cash flow challenges. A business doing $100,000 in annual revenue can be more financially stable than a business doing $1 million in annual revenue if the smaller company manages cash properly. Sustainable growth requires planning. Before chasing bigger sales, ask yourself whether your business has enough cash reserves to support that growth without creating unnecessary risk. Another major reason businesses fail to keep $10,000 in the bank is inconsistent spending discipline. Many expenses seem small when viewed individually. A software subscription here, a marketing tool there, a premium service, a new piece of equipment, a few convenience purchases. None of these decisions appear dangerous on their own. The problem is that dozens of small expenses accumulate over time. Imagine spending $100 here, $200 there, and another $300 somewhere else. Individually, these purchases feel harmless. Collectively, they can remove thousands of dollars from your bank account every year. Smart business owners regularly review expenses and ask a simple question: does this expense directly help the business generate revenue, improve efficiency, or reduce risk? If the answer is no, the expense deserves scrutiny. Businesses rarely go broke because of one massive purchase. More often, they slowly leak money through hundreds of unnecessary spending decisions. A fourth problem involves customer payment delays. Many businesses complete work today, but wait weeks or even months to receive payment. During that waiting period, expenses continue. Employees expect paychecks. Rent is due. Utilities arrive. Suppliers want payment. The business becomes trapped between outgoing expenses and incoming revenue. This creates constant pressure on cash flow. One of the simplest solutions is improving payment terms. Consider requesting deposits before starting projects. Consider offering incentives for early payments. Consider invoicing immediately rather than waiting until the end of the month. Even small improvements in collection speed can dramatically improve cash flow. If customers normally pay after 60 days and you reduce that to 30 days, the impact on available cash can be enormous. Business owners often focus heavily on generating sales while ignoring how quickly those sales turn into actual cash. The fifth reason is failing to create a dedicated cash reserve system. Many owners say they want $10,000 in the bank, but they never create a process to make it happen. They simply hope there will be money left over at the end of the month. Unfortunately, hope is not a financial strategy. A better approach is treating your cash reserve like a mandatory expense. Every time revenue enters the business, automatically move a percentage into a separate reserve account. Even if you start with just 5%, consistency matters more than size. Imagine a business that consistently sets aside money every month. Over time, that reserve grows into a financial safety net. When an emergency occurs, the business does not panic. When an opportunity appears, the business has options. Building a cash reserve is not about waiting until you have extra money. It is about creating a system that ensures money is saved before it gets spent elsewhere. Another common mistake is underpricing products and services. Many business owners worry that higher prices will scare customers away. As a result, they charge less than they should. The business stays busy, but cash remains tight. Imagine working harder every month while your bank account never improves. This often signals a pricing problem rather than a sales problem. If your costs increase, but your prices remain unchanged, your margins shrink. Over time, the business becomes increasingly vulnerable. Regularly reviewing pricing is one of the most important financial habits an owner can develop. A small increase in pricing can often create a significant improvement in cash flow without requiring additional customers. Businesses do not survive on revenue alone. They survive on healthy margins and strong cash generation. Now, let's talk about a practical plan for reaching and maintaining $10,000 in the bank. First, track cash flow weekly instead of monthly. Weekly reviews allow you to identify problems before they become crises. Second, separate operating cash from reserve cash. Do not keep everything in one account. Third, eliminate unnecessary expenses that provide little value. Fourth, improve customer payment speed wherever possible. Fifth, review pricing and profitability regularly. Sixth, save a percentage of every dollar that enters the business. Seventh, avoid making emotional spending decisions during good months. Many businesses have strong months and immediately increase spending. Then a slower month arrives and financial stress returns. Consistency is far more important than reacting emotionally to short-term results.